little by little, you see the stock go from 200 to 100 to 75 to 50, and the account gets wiped out. Millions of dollars gone. Hey everyone, I am Andrew. I'm the owner of Lever Wealth Management, which is the financial advisor for people who scare financial advisors. I'm also a CFA Charterholder and CFP professional who spent the last several years helping ultra high net worth and high net worth investors and clients work through their complex financial lives. And I take those learnings and the thousands of reps that I've had, and I'm giving them to you so that you can apply them to your own life. And today I want to talk about single stock concentration. Most people will fall into one of what I'll call three camps. And I think about this person that I dealt with who sold their company, and as part of this sale agreement, they were required to own stock in the acquiring company, which is not abnormal in any way. And it was a significant amount of money, in the millions. And so we went through their retirement plan, and we had to implement some non-traditional techniques that I'll get into here in the back half of the video, so make sure to stay tuned. But the problem was, once they got into the company, once they got in there and realized how things were being run, they understood, hey, this isn't a great company. The problem is, a lot of their sale agreement was in stock. And the company that acquired them doesn't want you to sell that stock. That doesn't look good. And you are not allowed, insider trading says, I cannot trade on material, non-public information. So they couldn't do things like short the stock or buy put options. That's almost never on the table. Every time we met, stock went from 200 down to 150, 125, 200. Ended up getting down into the 30 range, almost a loss of 90%. And so the question is, how do you protect against this? And again, I see people generally fall into three camps. Not everyone's like this, but I think this will give a good broad overview. The first is the easiest to mitigate and the dumbest, in my opinion. And it's people who have significant single stock concentration and don't have to. St. Louis Family Trust, credit where credit's due, they did a fascinating research paper years ago that blew my mind. And what they did is they looked at the whole stock market since inception in the US. And what it showed was a disproportionately small amount of stocks created all of the wealth. It's the 80-20 rule on steroids. Half of the stocks that have existed in the US have returned negative. Half of the stocks that have existed have given negative returns over their lifetime. Only about 40% of stocks perform at or above a 3-month treasury bill, which would annualized be in the 3 range, 3.5 maybe. Only 40%. But a disproportionately small amount of the stocks have created almost all of the wealth that's been accumulated. And so you look at that, you zoom back out and you go, if I buy stock, I have a 50-50 shot of negative returns. People take the odds at the index level, right? A lot of people talk with the S&P of 3 up, 1 down. 3 out of every 4 years, the S&P 500 is going to be up. You have about a 75% shot of it being positive in any given year. But that's at the index level. That's not at the single stock level. Over its lifetime, I have a 50-50 shot of a stock being positive. And you can stratify the data in different ways, but the fact of the matter is, stocks have significantly higher volatility than an index. If you own single stocks, usually it's due to one of two reasons. One, there is some sentimental attachment to it because it was handed down, or you'd put money into it and you ended up being right and it grew quite a bit. And so you don't want to get rid of it because you feel some emotional connection to it. And I can empathize with that. I've had a few stocks that I've owned over the years, and I'm like, oh, you know, it's almost nostalgia in a way. The easiest way to invest around this is keep some amount of it. Keep the ticker. To take the shares down from 1,000 to 10. To retain the stock doesn't mean you have to retain the concentration within the stock. You generally don't want more than 5 to 10% of your net worth. Really, 5% of your net worth in any one given name. The second reason people typically don't want to sell a stock is because they go, I don't want to pay the tax on it. If capital gain rates are at 15% for somebody who makes under $500,000 a year, which is most retirees, the stock only has to have a minus 15.1% movement for you to have been better off paying the tax. And the underlying volatility of a stock is probably 40-ish% a year. So if you expect the stock to do 5% return, it could do 45, it could do negative 35. So if you're a person who has some sentimental attachment and there's emotion with it, I understand, I get it. That doesn't mean you have to own all of the stock still. Keep it in the portfolio, but divest of some of it. If it's because you made a good decision, you need to ask yourself, am I smart or am I lucky? Because a lot of times, if we're honest and humble, you were lucky, and that's okay. You made money. Good on you. But that doesn't mean that your next pick is going to be just as good. And it doesn't mean that this pick will still be good in 10 years. What has been is not necessarily what will be. And if it's the tax issue, understand that the volatility of a stock is most likely more than your tax bill would be in any given year. The second more difficult group that people fall into is, well, I can't sell the stock, which is where this person was. And so then you have a few options. Again, the most ideal scenario is you can bet against the stock, and it essentially becomes an insurance policy by buying put options or shorting it. The problem is almost all people who cannot get rid of a stock are not allowed to do that, so I'm really not going to focus on that. Probably the better thing to do is you can bet against the sector that it's in. Most of the time that's available. If, for example, you own a stock that's in energy, what you could do is you could buy the energy ETF and buy put options on that. You could short it, and hopefully there's enough of a correlation there that if my stock goes up, it's because energy itself is going up, and vice versa. If my stock goes down, hopefully it's because that sector itself is having a downturn. And if I have a put option, that insulates me from some of the losses. The problem is some of the volatility of a stock is due to the industry and sector specifics. A lot of it's just due to the fact that it's an individual company, right? And bad things happen to good companies, bad leaders get in, things that you cannot explain away or insulate yourself from at the sector level. So there's risk with that. Another way, which I tend to prefer rather than what I'm calling the insurance option, is you find non-correlated sectors of the economy and invest around it with those. And so with energy, usually if there's a recession, energy prices tend to go down. Energy stocks don't perform well. So you could buy an anti-cyclical sector like healthcare that tends to perform well regardless, or consumer staple stocks. People buy toothbrushes no matter if the economy is good or bad, right? They may change the brand, but they're still going to brush their teeth. And so you can play with that and figure out, okay, well, what are the types of companies, what are the indexes that perform least similar to my company? That's usually where you end up. The third bucket of people, which can be far more difficult to deal with, is I own this company because I like this company. I've been right because I have been smart, and I think it will continue to go up. And I've actually only seen one person be right on this in my whole career. So that's a tough one. And with this one, if you have a view, far be it from me to get in between you and your view on a stock. However, what I will caution people with is your retirement plan is probably wrong. If I own a small cap stock It's $1 million of my portfolio. And I input it to my financial planning software, and I say it's 100% small cap. The software is going to assume the risk of a small cap index. So it's going to assume return, and it's going to assume volatility, or which is quasi for risk. The problem with that is the underlying stock has a volatility, again, of 3, 4, 5 times the index. And so your Monte Carlo analysis, which everyone loves to talk about, is completely wrong. I'm going to say that again. If you have an individual stock in your financial planning software, your financial planning output is completely wrong. You cannot rely on a Monte Carlo analysis that assumes index level risk for stock level risk. You have this risk. The software is going to assume this. You get completely different outputs. What you need to do instead is do some scenario analysis and say, what if my stock doesn't exist? What if it goes down by 50%? How does that change the output for the remainder of the plan? Is my Monte Carlo, in spite of this negative return, or this going to zero like Enron, is my Monte Carlo still sufficient? Then you understand, what are my concentration limits here for a single position? That's how you correctly utilize that input to give a correct output, or at least somewhat correct output. You understand the goalposts better. I think you understand what I'm trying to say here. People end up usually in one of these 3 buckets, where I'd say it's, the tax or the emotion of the stock, and that's easily fixable. I can't sell the stock. How do I invest around it rationally? Which is an interesting game to play. And then there's this stock is going to continue performing well, and I'm betting on it. But then your planning output is most likely wrong, and you need to do some additional due diligence and modeling to fix that. And so my encouragement to you is, if you have single stock concentration, ask yourself why. Be honest and humble with yourself. And if you have a view, great. But make sure your planning software reflects that view correctly, and it's not garbage in, garbage out. Until next time, thanks everyone. See ya.